Certified Fraud Examiner. It has 4 modules or sections: financial transactions and fraud schemes, law investigation, fraud prevention and deterrence, financial transactions and fraud schemes, accounting concepts, financial statement fraud, asset misappropriation, cash receipts, asset misappropriation, fraudulent disbursements, asset misappropriation, inventory and other assets, corruption, theft of data, and intellectual property, identity theft, financial institution fraud, payment fraud, insurance fraud, healthcare fraud, consumer fraud, cyber fraud, contract and procurement fraud. Accounting concepts. Total questions in this section, 1 to 39. 1. David runs a local company. He keeps his books on a calendar year and used the accrual basis of accounting. In December of year 1, a customer placed an order with him to cater the food for a party that would take place. In February of year 2, the contract was signed and the balance was paid in full when the order was placed in December. When should David report the revenue from this party and the associated expenses of catering it? A. Both the revenue and expenses should be expenses. Record in December. B. The revenue should be recorded in December, when David received the cash, and the expenses should be recorded in February after the party takes place. C. Both the revenue and expenses should be recorded in February. D. It does not matter because it is up to David to decide whether he reports the revenue and expenses in December or February. The correct answer is C. Both the revenue and expenses should be recorded in February. Expenses are recognized in the income statement on the basis of a direct association between the costs incurred and the earning of specific items of income. This process, commonly referred to as the matching principle, involves a simultaneous or combined recognition of revenues and expenses that result directly and jointly from the same transactions or other events. For example, the various components of expense, up the cost of goods sold, are recognized at the same time as the income derived from the sale of the goods. In this example, since the expenses will not be incurred until David caters the event in February, the revenue David received should not be recorded until February as well. 2. The management of a publicly traded company may choose which set of financial reporting practices it wants its company to follow. A true, B false. B false. Publicly traded companies must follow the specific financial reporting practices of their jurisdiction, which differ among regions while US generally accepted accounting principles. GAAP and International Financial Reporting Standards, IFRS, are some of the most commonly used accounting frameworks. Countries may have their own form of GAAP that might contain different standards. IFRS is considered a principle-based accounting framework, and USGAAP is known to be a rules-based accounting frameworks. Proponents of IFRS say that a principle-based accounting system better captures an entity's true economic situation.